Mustafa, I mean, here we have Waller, who is a man that is very close to Powell. He's going to keep hiking. He wants to keep hiking. What does this tell you about our question of the day? Is this recession delivered, denied, or delayed?
Thanks for having me. Firstly, I agree with Governor Waller. I think that the market is overpricing the probability of a recession. It's hard to see recession coming as early as this is projected by the yield curve slope or the size of it as well. I think that the big problem will still be the persistence of services inflation and, of course, CPI.
What I don't understand, Mustafa, though, is we take a look at what's happening with the 2-year, right? You got yields up 13, 16 basis points at some point today. We're still pricing in 50 basis points of cuts, if not a little bit more, by the end of the year. And I appreciate that's come down, but still those two things don't make sense. What wins out?
It doesn't make sense. But the market has been predicting the Fed hikes from the beginning of this hiking cycle. In fact, even in 2004 hiking cycle, the market has underpredicted terminal Fed funds rate. I think the market is doing that now. So it could be that the market is predicting a big recession, but it also could be that there were a lot of positions that were betting against that got short when the SVB crisis started, and so that's keeping the rates, front-end rates, very low, unusually low. And I think that that's not consistent with an economic outlook, more consistent with some sort of position imbalance.
Mustafa, on that point, just to take a step back, this bond market has been extremely volatile. When the SVB thing was happening, we saw 2-year yields move a whole percentage point in the space of just 3 days. What becomes your guiding North Star when there's just this immense amount of noise in the bond market?
I think the market is predicting a little bit of the past, and in the past there was always Fed hike ended with a crisis, but this time around it doesn't look like there's a crisis ahead of us. So I think that what will happen, and there will be two factors driving the yield curve going forward, and not just the one factor that we have seen so far. The one factor that was driving the yield curve so far was inflation expectation, and translated into a terminal Fed funds expectation. I think that will change, and as it will change to not only the inflation will be a driver, but also how the banking system rebalances its asset liability management, and that's going to be increasingly important driver of the yield curve. So a lot of yield curve action coming up for the rest of this year.
Mustafa, in terms of the broader Fed stuff, I appreciate that that's what you're talking about. It is in some ways a little separate. In terms of the Fed hiking, though, the market's now pricing in over 80% of a 25 basis point hike in May. And then, like I mentioned, those cuts throughout the end of the year. What do you actually see happening?
I'm seeing the yield curve, the Fed most likely deliver to the market's expectation for the May hike, but market will not deliver the eases, almost 8 eases that's a price till middle of 2025. I don't see Fed delivering for the rest of the year, and as a result, the front end will be constantly disappointed and constantly correcting itself. Probably higher yields in the front end of the curve, and probably higher yields in the long end as well.
Okay, higher yields, and that lends me to what I wanted to ask you. In terms of the 10-year yield, because we've been talking about the front end, but 10-year still seems pretty confident that inflation will come back down to the Fed's target. It's now just below 3.5%. So where's that got to move to in your estimation?
Well, if you look at the 10-year break-evens, it's been in a very tight range from the beginning of the Fed cycle, which was somewhere between 225 to 250, and it hasn't really moved at all. So market has no worries about long-term inflation being anchored somewhere between 2 and 2.5. The market's bigger concern is how long will it take for current high, especially services inflation, normalize to something close to the Fed's target, which I don't think is going to happen in the next couple of years.
When we go one more time in May, right, and then we just hold for a while to see, what are the actual chances that inflation starts to re-accelerate? I mean, just take a look at the UMich one-year inflation expectation numbers, right? They're coming in 4.6%. Gasoline prices are already starting to rise up again. And if we don't really just squash it right now, what are the chances?
I think there will be chances of re-acceleration because if the main driver for the core inflation data is the shelter component of the CPI, and that's the good news was that it came down in the latest reading, but it will not be going down straight because some of the real-time indicators of rental like Zillow.com, etc., are coming back up again. So CPI shelter will have ups and downs, maybe drift down over time, but not big declines as some expect in the market.
Right, like you're not going to all of a sudden squash into two. Mustafa, really great to get your perspective. Mustafa Chowdhury, Macro Hive Chief Rate Strategist. Thank you so very much. All right, coming up, back to the